like you said, you can be cash flow positive and you can be making a profit, but in the eyes of the IRS, you're actually losing money. And so you can actually, be writing off and getting a tax refund, even though you're making hundreds of thousands of dollars because of this big thing called depreciation.
All right, welcome back to How to Invest in Commercial Real Estate. The boys are back in town. No?
Braden had a birthday yesterday.
Yeah, Braden's birthday.
Yeah, comment below if you think I'm closer to what is it? If Joel is closer to me or Brian
in age,
get a good look at us now.
Also in 1 out of 10 in looks, whether he's closer to Braden.
No, let's not have him do that.
Also, to give you a hint, I watched Braden get ID'd at dinner last night before the guy would serve him a cocktail.
I did. Yeah, that happens. They normally ID everyone else at the table just so that you guys don't feel left out.
I didn't get ID'd.
I said normally.
Oh.
Yeah. You're obviously old enough to drink.
No, true story. I'm in the bar at the airport traveling overseas, and they have the sign that says, "We ID everyone." Yeah. And this guy sits down next to me, and no joke, he might have been 90 years old. No hair on his body was not 100% white. Wrinkles all over his face. Maybe he was 85, could barely walk. And he orders a beer, and she IDs him.
Oh, my gosh.
And he complains, and she's like, well, we have to ID everyone. And I'm like, you don't have any room for common sense at all? There's no common sense here? I don't know why we're talking about that.
Anyway. Another really exciting thing is the Criterion building is finishing up. So that's obviously our new HQ up in Owasso. Yeah. They finished up the parking lot today. We should have plants in the ground soon, certificate of occupancy, or the first certificate of occupancy here in the next couple of weeks. But more importantly, we opened up an awesome co-working company up on the 3rd floor. So it's got this massive balcony, tons of shared space, private offices, conference rooms, everything you would find at a normal co-working space. Anyway, if you are in the Tulsa, Owasso area, feel free to drive up to Owasso, check it out. We're accepting reservations now. We only have 1 office left. There's room for tons more people, just not an office. And if you mentioned you heard about it on the podcast, we'll give you a special little deal.
All right.
Cool. What are we talking about today?
So today is, going down to the fundamentals. One of the most important things you have to be able to do is understand a profit and loss, understanding a P&L, understanding an income statement, whatever you want to call it. You've got to be able to decipher where the money is coming from, where it's going, how much ends in your pocket, yada, yada, yada. You've got to be able to understand that. So we're going to go through the list today. There's about 8 items that you need to know what they are, what they do, and more importantly, where they go.
And we still get asked about this all the time. This is kind of one of the number one questions people ask me are about real estate terms and understanding where the money's coming in and the expenses. And every once in a while, we still have bankers that we don't know if they understand exactly a real estate P&L and how that works. So yeah, let's get into it. We'll keep it simple. We're just talking about a real estate P&L today.
So obviously, the first and most important one is gross income, right? You've got to have revenue. You've got to have income from somewhere. Where is it coming from? Your tenants, right? So if it's an apartment complex, they pay a monthly rent. If it's a commercial shopping center or really anywhere else, there's a monthly, at least base rent. And there may be additional things if it's a retail center or an industrial deal or any sort of triple net type lease. You're going to have additional things that you're paying, right? They're going to reimburse you for.
It could be as simple as a laundromat in a multifamily, right? That would go towards gross income.
But yeah, your first task though is to decide or to understand. We say gross income. You can interchange that with revenue.
Yeah, right.
Revenue, gross income, or gross revenue. All of those are encompassing all the income that you might be able to collect on this property.
Right.
So yeah, you have base rent, but they may pay extra things on an apartment complex. You may have pet rent. You may have non-refundable deposit income. You may have utility income. All those things are rolling up into gross income or gross revenue.
Yeah, and you're going to see that in the offering memorandum. They're going to have the gross income for the next year probably broken out. Once you get in contract, they'll probably give you the trailing 12 months of financials to where you can see the previous 12 months of income. So you should be able to get a pretty good understanding of just the income.
Okay. And then so if you get a P&L, you said you typically get the previous 12 months. You don't get back 3 years or something like that. Like
we asked
a lot
for
of
3 years.
might do.
We asked for 3 years, I think, in the contract, but the previous year is most important. You want to make sure it's trending in a good direction. There's not anything weird.
Yeah.
But you can get 2 to 3 years.
I think I'd like to see, more than 12 months of that.
Absolutely. Yeah. And then obviously once you get a good understanding of income, you need to understand how much it costs to operate that property. You have obligations as the landlord, whether it's any asset, you have obligations in that lease that most likely cost you money. And these are going to go in the expense category. Obviously, the expense category is right below the income category, but there's multiple different types of expenses, right? They're not all equal. There's expenses that maybe you as the landlord pay 100% of, whether that goes up or down, you don't get reimbursed from the tenant. We'll talk about multifamily, for example. So when you buy an apartment complex, it is so crucially important that you adjust the P&L for your real estate taxes at your basis, right? Because the seller most likely has a lower basis and is paying a lower property tax bill. So that's the first one right away. When you buy an apartment complex, you can't go to the hundreds of tenants and say, hey, you owe me an extra $5.75 a month because the property taxes went up. That doesn't happen. So you need to understand the impact of expenses that will stay the same, that will be reimbursed, and that you will be responsible for, I think.
Yeah, in multifamily, you'll have payroll, which you wouldn't necessarily have on a retail center. You would translate that into management fee. But yeah, lots of those. I'd like to put up a couple of sample P&Ls during the show when people are watching.
Yeah.
So you've got maybe give them a sample retail P&L and a sample multifamily P&L just so they can kind of see the differences.
Yeah, and one of the bigger things in the retail P&L, if you're buying a triple net deal, which most of the retail shopping centers we buy, all of the tenants are on triple net leases, which if you haven't been watching the show for the past year, you may not know what triple net means. Triple net just means they're reimbursing you for the insurance, the common area maintenance, and the property taxes. So if all of your tenants are on triple net leases, you can pretty much skip over the expense section. You can just hop right over that. Doesn't matter. The tenants pay for it. You just have to make sure the tenants pay for it.
Yeah, because they pay for it, but you would collect the income. So that income would show up in the gross income. You would have base rent and you would have triple net income. Then you would have the triple net expenses and then the operating expenses.
Okay. So let's talk about an owner expense that you may experience in retail, even with a triple net lease, right? Like you're probably going to have to file a tax return. So you're going to have $1,000 or $2,000 in bookkeeping or accounting or tax prep or whatever you want to call it. You're probably going to have some attorney's fees, renew some leases.
Big capital expenditures,
like roof, maybe parking lot, maybe HVAC units, maybe. And again, all of this is in the lease. So you need to look at the leases and see what is supposed to be happening. And you'll find pretty quick that doesn't always translate over to the P&L.
Yeah.
You find some opportunity or you find some slippage and you have to bring that to the seller's awareness. If it's slippage, if it's opportunity, you may just want to keep that to yourself. And that's your value add, right?
Yeah.
Okay, so we've talked about gross income or gross revenue. We've talked about expenses. Then you come to the all-important line after that, which is net operating income.
I think it's important that you called it the line. We're going to refer to that a lot. The NOI or the net operating income is the line.
And it's strictly gross income minus expenses, right? As simple as that, right? I mean, there's a lot of expenses and a lot of things that go into it, just like we talked about. But
yeah, the only thing that you could consider an expense that is not above this NOI line is the one that we're going to talk about in a second, which is debt service or your loan payment. The NOI is absent of of any loan.
Okay.
And so let's just bridge this gap while we're talking about NOI and debt service. Why is the debt service below the line?
Well, the net operating income is used to value commercial real estate. And since everyone is going to be getting different debt, maybe they don't get any debt at all, then it's not relevant to valuing the property. And so that's why they want to keep the NOI clean because someone may get 30% loan, someone may get an 80% loan. The interest rates might be different.
They may buy it in cash.
Yeah, someone might want to put a 20-year amortization on it. Someone may want to put a 30-year amortization on it. And so that varies the debt payment and it has no relevance on the value of the property. So we keep it out of the NOI line in order to value the property appropriately without all that mess.
Yeah, that makes sense.
Let me ask a really dumb question right now. Why is NOI used to value the property? You said NOI is used to value the property. Why are we coming up with the value from the net operating income?
Well, I can already see the comments in the comments section. Well, Joel, you don't use NOI always to value the property, but it is one of the three ways they value property: the income approach, the comp sale approach and the cost replacement approach.
Right.
But in our world, the reason the NOI is used to value the property is because that's what you're buying. You're buying an income stream.
There we go. You're
And
buying
so
an income stream.
that's how we see it.
Yeah.
Is we're buying cash flow, we're buying an income stream, and so it's all relative to what multiple someone is willing to pay for that income stream. And that leads us to the next term that's super important. Is
the
cap
comments
rate.
are rolling already. Cap rate. People hate us.
Oh, wow.
Is the cap rate.
You guys are using cap rate wrong.
Let's see if we can talk about it one time without someone telling us that we're.
I want
using
someone
it
to comment
incorrectly.
about how we use cap rate that's got a bigger portfolio of real estate than us. And then maybe, and I know there's plenty of people that have bigger real
Sure.
estate portfolios than us.
But they're
that
not
argue,
the ones telling us that we don't know what we're doing.
No. It's like Dirk the Great 75 on YouTube, man.
Well, and so cap rate really isn't part of the P&L experience. So let's not spend a lot of time on that. But it's the NOI line is so valuable to the cap rate because they're two pieces to a 3-part puzzle. You have value and you have NOI and you have cap rate. And those all work together. So if you have the cap rate and you have the purchase price, you can determine the NOI. If you have NOI and purchase price, you can determine the cap rate.
I see.
And so they're all 3 parts are working together there.
Yeah, and cap rate is quite literally used in appraisals to value property. What they do is they assign a market cap rate, which is basically like an earnings ratio for stocks. Right? You can look up the earnings ratio of all of these companies and it's where they trade versus how much money they make. If you can track that.
Yeah, PE ratio is something obviously used
It's the same
in
thing.
stocks. It's very similar to a cap rate in real estate.
Yeah.
Okay, let's keep going. The next one I put down here is debt service. So now you've got your NOI, but remember we keep the debt service below the line, and your debt service is just your mortgage payment, essentially, for a real estate deal, just like you have on your house.
It is. It's literally just the mortgage payment. There's no escrows. I mean, there may be. Let's not overcomplicate it. It's the mortgage payment.
It's the mortgage payment because the escrows, you have those separated out in commercial real estate where they all may be lumped together in your home mortgage payment. But those are separate in real estate. So the debt payment is just your principal and your interest.
Okay.
So it's important to calculate this because the principal is obviously, you're kind of paying the loan down. So that's a return in a sense, right?
Yes.
I mean, that's adding into the IRR at the end of the deal is we're paying down this debt, this amount every single year. So that's a number that we can pull for every single property. How much are we paying down in debt this year? That's almost the same as free cash flow, theoretically, if you can sell the deal.
So and maybe I'm skipping ahead, but would net operating income minus debt service, would that be considered cash flow? I mean, is that a proper term?
That's what I would call the net cash flow.
Yeah. We may get comments, but yeah, I think that's as simple as it is. Cash flow is the money that you have at the end of every month or at the end of every year. NOI is theoretical because once again, the debt payment takes away from that. But cash flow doesn't. Cash flow is after your mortgage payment. What do you get in your pocket?
Yeah. Right.
Well, it's theoretical because if the three of us had 3 different real estate companies and we went and bought the same deal, odds are we'd each end up with a different loan and a different cash flow, but the same net operating income. So there's a lot of kind of magic in the debt service, and there's a lot of value to be had simply by getting a better loan.
So I got a question for you guys. Is there any difference between profit and cash flow? And if so, what is it?
Yeah, there's a massive difference between profit and cash flow.
Okay, what is it?
Right? Because profit is like NOI, right? Right?
Yeah.
And cash flow is what you're actually putting in your pocket. So you can be profiting, like Criterion, for example. Criterion profits a ton of money, but we're constantly reinvesting it back in, so our cash flow isn't the same. I feel good about this.
Okay, well,
you're going to make me try to. You're going to try to make.
Well,
me
you
look
said
like
it's the same as NOI, and it's not necessarily because the NOI isn't profit if you have a debt on it. Like the interest is an expense.
True.
So profit is your NOI minus your interest expense, but not the principal payment. portion.
Oh, okay.
For tax purposes, the principal portion is considered profit, even though it's not included in cash flow because it isn't money that you're getting. It's going to the bank to pay down the loan. So that, just so you know, profit is different than cash flow in that cash flow is lower. It's lower than the profit because the profit includes the principal pay down.
I see.
But we're not calling taxable income profit, right?
All right, let me think. Well, you're not calling taxable income.
Yeah, see, this is my turn.
Profit.
Yeah, get ready.
Taxable income is not equal to profit. No. And why is that, Braden?
The next point.
The next point,
which is
maybe the last one.
Amortization and depreciation.
Depreciation. That's right. So depreciation is one that you need to understand. It does not impact cash flow. It does impact profit for tax purposes.
So I'm glad we saved this one for last because I think this is one of the beauties of real estate is the fact that you can be cash flowing at a certain number, but you could potentially lose money on your tax return. And that is because of depreciation.
Yeah.
So somebody break down depreciation in the simplest form possible.
Brian, you want to try?
Go ahead.
Okay. So depreciation, it's in the eyes of the government for tax purposes, they're considering that these commercial buildings are depreciating or going down in value over time, but you don't always have to spend that money every year. Mm-hmm. Let's say the roof is $1 million. I may have a new roof on right now. That new roof is deteriorating over time, but I haven't spent any money on the roof. Mm-hmm. But the government allows us to say, okay, the roof is worth less than it was last year. And they allow us to then say, okay, well, you kind of lost money on the roof. We're going to allow you to depreciate or deduct that loss of value in the roof on your tax return this year, even though you didn't pay the money.
Yeah.
And if you can do that across all the building systems, the depreciation can be a big number.
Similar to how a business might depreciate some of their equipment, right?
Yes.
Computers
or
trucks.
Yeah, cars. Yeah.
If you're not a business owner, if you haven't been in business, you're not going to understand that point either.
Yeah.
So I don't know how we would relate it to someone that doesn't understand it. But basically, it is a way to...
It's the entire premise of the show.
Yeah, that's right.
Yeah.
But it's important because, like you said, you can be cash flow positive and you can be making a profit, but in the eyes of the IRS, you're actually losing money. And so you can actually, be writing off and getting a tax refund, even though you're making hundreds of thousands of dollars because of this big thing called depreciation.
Yeah.
So I have a couple questions. The first one is, what happens when you put a new roof on, tax-wise? Do you just start depreciating that, or do you just add it in as improvements? And does it have the same depreciation schedule? Or, you obviously just can't write it off. Like, they can't allow you to depreciate it and then just write
it off. Yeah. So if you let's say you spend that $1 million in 5-10 years, you don't get to write off that $1 million in that year. You have to then start depreciating that again over time.
So are you saying if you do replace the roof and you spend that money, you can depreciate that money?
You depreciate that on the new schedule. If it's got a,
okay.
20.
Now, we are not tax professionals.
Yeah.
But we do get the benefit of the power of depreciation to offset our income.
If you own more than one house that you live in, you need to have an accountant do your taxes. Okay. We don't do our own taxes. We have an understanding of it, right? But why would you even try to do your own taxes? A good accountant should save you more money than... Anyway, I'm off of that.
All right, let's round it up because we want to keep these shows short.
But real quick, the power of sending somebody, let's say, $100,000 in distributions, and they get a K1 and it's negative $50,000.
Yeah,
we get a phone call. It seems like every time from an investor that doesn't quite understand that. Hey, Brian, we sent you, or you sent me $100,000 last year, but this says I don't owe any taxes.
Yeah. Says I lost money.
What? Yeah. How did that happen? Yeah. We didn't lose money, did we?
Yeah.
Well, it's like, those checks cleared, didn't they?
Yeah.
And this is a K1. Yeah. And that's the beauty of investing in real estate, right? If you're a high W-2 earner and you're in a job, let's just say you're making $500,000 a year, half of that is gone. So if you can make $500,000 a year in real estate, it's almost like making $1 million as a W-2 employee. You can settle with making half because you're taxed less.
Yeah. Real estate is a great investment for everyone. But if you're making a huge W-2 income, it should be part of your focus to get involved in real estate, because you can begin to write off. If you have enough real estate losses and you can qualify, or your spouse can qualify as a real estate professional, you can write off those losses against your W-2 income. Now you're really, really making money.
Yeah.
All right, let's recap.
All right, gross income or gross revenue. Then we've got expenses, both the ones that you have to pay and the ones that even the tenants reimburse you for. We have the net operating income, which is the important line. Below that, we talked about cap rate and how net operating income, cap rate, and value or purchase price all interchange. Then we've got debt service. We've got amortization, cash flow, and depreciation.
That's it.
It's pretty simple when you think about it. I mean, income minus expenses equals NOI. Yep. You're dangerous just with that calculation right there. Yep. And then you start throwing in our cap rate ideology, and everyone's going to hate it.
Last point I'll make is kids get out of high school and some get out of college without ever having the ability to read a financial statement or a profit and loss statement.
I did.
And it's so important in looking at a lot of different investing opportunities. So educate yourself, call us with questions, comment if you want,
especially
hit the like button.
Rate. Yeah, comment about the cap rate.
And don't forget, is Joel closer to my age or Brian's age? This could be a fun one. Comment below.
All right, guys. See you next time.